We got about 5 minutes before we get started. So let me ask you a couple of questions. How many of you have heard me talk over today and yesterday? Okay. Let me ask you another way. How many of you have not heard anything I've said? Okay. And Will, if you get an opportunity, would you close these outside doors, please? Yeah. So here's what I'm going to be talking to you about today. It's all about being prepared for a bear market. Because just as sure as you're sitting there, one's coming. And the key is, what are you going to do about it? How are you going to survive it? What's your approach? I'm recommending everybody that... I'm a money manager, by the way. My name is Mike Turner. Thank you for being here, by the way. What I encourage you to do is to ask yourself the following questions. And if you're not managing your own money, then ask your money manager these questions. And don't accept smoke for an answer. Okay? And here's the questions. What's your plan for my money in the next bear market? You don't want to hear obfuscation out of that. You want a clear answer. Next question. When will you invoke that strategy, assuming that they have one? What will be the trigger to invoke that strategy? How will you know when the next bear market begins? Does anybody know when a bear market starts? No. So at what point will you or your money manager decide, I need to change my strategy? Or is the strategy going to be the same? Hopefully your money manager will not say the following to you. And hopefully you're not saying this to yourself. Oh, the market will come back eventually. Just stay in for the long haul. Okay, a couple more minutes. So the objective here is this. I'm going to take, by the way, if you've got questions and you can't get to me as we get toward the end of this, I've got staff in the back. Raise your hand, Will, the guy standing in the back, and Ron, and they can answer questions for you. So here's what I'm going to do. I'm going to take you through the methodology that I use to manage money for my clients, and hopefully in this process I can teach you how to do this on your own if you don't want to hire me to manage your money. As I am absolutely confident everyone in this room should hire me to manage their money, I'm fairly certain that not everybody's going to do that. So the thing of it is, I don't want you just sitting in here saying, okay, I didn't learn anything except that Mike wants to manage my money. So I've already made that statement. You know that's what I want to do, and that's what I would like to do for you. But I am now going to teach you what I have learned and the methodology that I use. Now, I'm going to have tools that you don't have, but you can get there. There are a lot of tools that are out there on the market, and you can get to a lot of what I'm talking about as we go through this. Okay. By the way, if you want to talk to me later, I'm in booth 525, all the way at the back of the exhibit hall. Here's what everyone wants to know. How long will this bull market last? Now, I'm assuming everyone in here thinks we're in a bull market. Does anybody not think we're in a bull market? Okay. When will the next bear market begin? Anybody have that date? How long will the next bear market last? Anybody know that? How bad will the next bear market be? Terrible. Should I stay out until after the next bear market ends? Should I just stay in cash? I know it's probably getting close. Maybe I should just stay in cash for now. Will the next bear market be worse than the 50% drops of 2002 and 2008? Yes. We have a yes here. How do I protect myself in the next bear market? With the right strategy. So, with the right strategy, How long will this bull market last? You won't care. Isn't that an interesting response? When will the next bear market begin? You won't care. Not with the right strategy. You won't care. Each one of these, you won't care. Should I stay out until after the next bear market ends? Absolutely not. Will the next bear market be worse? Da, da, da. You won't care. How do I protect myself? You won't care. Seriously? I mean, come on, Mike. We all want to know those answers. You can't just say that. Seriously? How can I not care? You want to stay fully invested in fundamentally strong stocks in uptrending bull markets. Now, this is not rocket science. I buy for my clients large cap, large mid cap, blue chip stocks that have great fundamentals, that have an upward trend. You can find those. I'm not the only guy in the world that can find those. Yes, I have a system that rates, ranks, and scores them all that sort of thing. But you can do that. You can dig through systems and find out how to do that. The key here, in bull markets, unlike some money managers who say, you should do that in bear markets too. You should not. You want to sell and go to cash in transition or neutral markets. I am not afraid of cash. Cash is a great place to be when the alternative is losing a boatload of cash in a bear market. But I don't sit on cash in a bear market. I'm fully invested in a bear market. You want to stay fully invested in technically uptrending ETFs in bear markets. Well, what ETF goes up in a bear market? What'd you say? Gold. Maybe gold goes up, maybe not. Inverses. Who is the genius that said that? Oh, and over here. Two geniuses. Okay. Yes, inverse. How many of you in here do not know what an inverse ETF is? Good. I'm going to show you what they are. Everybody knows what an ETF is. Exchange Traded Fund. It's the same thing. Inverse ETF just goes the opposite direction. You have the SPY. Probably most of you own shares in the SPY, right? Market goes up, what does the SPY do? Goes up. Market goes down, what does the SPY do? Goes down. The inverse of the SPY is the SH. When the market goes up, what does the SH do? It goes down. When the market goes down, what does the SH do? It goes up. It's just the inverse. Okay. This way you're making money in both bull and bear markets, and you never have to worry about how long the bull market will last or how bad the bear market will be. You will embrace the market, whatever the direction. And a whole bunch of you, thank you very much, have told me that you're going to put money with me. Thank you. And I don't want to scare you when I say this next statement, because you're brand new, almost clients. I'm actually looking forward to the next bear market. Okay? You're not going to hear a lot of money managers say that. All right. So, what you should know by now. The odds are overwhelming that a bear market is on the way. The average time between bear markets is 4.5 years. How long are we in this bull market? 6.5 years. Average bear market correction is 38%. That's the average. What were the last two? Down 50. If we are in a secular bull market, secular meaning it's on trend for 10 years or more, it goes up on average 753%. But here's the kicker. There's only been 2 in history. Only 2. Okay? The current cyclical bull market is 6.5 years old. So we have to wait 3.5 more years to see if it's going to become a secular, meaning more than 10 or more years in length. But in the meantime, the market could be cut in half within the next 24 months. Now, I know you care about that, and I care about it only because of the wonderful opportunity it is. But I don't worry about it. I was interviewed, a radio show called me a little over a week ago. And they interviewed me about what I thought about the market and what I'm doing and all that kind of stuff. And then the host stumped me for a moment, asked me a question I wasn't prepared for. Now, I like to be able to answer any question. You can throw anything at me, and I like to give an answer. Hopefully, it's intelligent. And so he asked me, he said, okay, Mike, he said, what keeps you awake at night? And I had to think about that. I didn't want to be flippant to him, because I can remember it was not too long ago that I did worry about what the Fed's going to do. Oh, are they going to raise rates? Oh, are they going to lower rates? What gold's going to do? What silver's going to do? What oil is going to do? What Russia's going to do? What China's going to do? What the government's going to do? Whether or not Obamacare is going to kill the country. Whether or not we're going, whatever it is. Lots of things to worry about. I don't worry about it. I do think about them when I'm awake. They don't keep me awake at night. I worry more about the fact I'm overweight than anything else. I don't worry about those things. Okay? Now, a buy and hold strategy could kill you in the next bear market. I'm not going to ask, so don't raise your hand. I'm not going to ask how many in here are in a buy and hold strategy, meaning you own mutual funds, meaning you're a value investor, meaning that you're a growth investor. Those strategies, if you're not really careful, will kill you in the next bear market. A money market or cash strategy, it won't make you any money in the next bear market. And what's really bad is that since you don't know when that next bear market is going to occur, it's when you wake up and realize how much money you've lost in the last 3 or 4 or 5 months or year, and you're thinking, holy crap, this is probably a bear market. Why didn't I get out a year ago? Well, I'm going to hang on now because it's probably at the bottom. And I hear all the time that retail investors always get out at the bottom. I'm going to hang on. And it goes down another 15%. Okay? At an average gain of 10% a year, if you lose 50% like happened in 2008, it takes 7.2 years to make your money back. Now, your money manager will say to you, see, it came back just like I told you it would. If one says that to you, please ask them the following question. Where's my damn 7 years that you just took out of my financial life? Don't tell me it came back. What about all that time and money I lost? You don't want to come back. You want to make money in a bear market. So hopefully in your mind you are saying, okay, Mike, can you get to the punchline and tell us how to make money in a bear market? Yes, I will do that. It's extremely foolish to sit on the sideline as the market triples, and it could. Without the right strategy, you're bound to lose 40, 50, could be 60% next bear market. There's a solution. It's an obvious one. You must know, and this is simple to state, hard to know. You must know the bias of the current market. What is it today? You don't care about what it's going to be tomorrow. It's easy to know what it was yesterday. When you turn on CNBC, when you read analyst reports, whatever it may be, and they talk about what's going to happen, what they think is going, their best guess about what's going to happen. Had an august panel up here in the previous hour telling you what they thought the world is going to be in the future. They're guessing. Good people, smart people, they're guessing. I don't care. If the market goes up, I'm going to make money. If the market goes down, I'm going to make money. That's the way you want to make money in the stock market. Okay, but you got to know the bias. Are we in a bull, bear, or neutral? And I know what we are. I know that we are 1.82% above neutral in a bull cycle. And I know that the average position of the market is about 4.5% above neutral. So we're close to neutral, but we're not in it. So what does that mean? What am I doing with my clients? All in. 100% in fundamentally strong, uptrending stocks. Period. Do I have to worry what the market's going to be tomorrow? No. I'll measure it tomorrow. I measure what the market's doing, not what it's going to do. Oh, you can forecast charts. You can have double tops, double bottoms, ascending triangles, descending triangles. You can have Bollinger Bands. You can have Fibonacci's. You can do anything you want to do. I've even developed a system that I spent millions of dollars on developing. Great. Bloomberg has it on all the terminals all over the world. And it tells you what the market's going to do for the next 90 days. Really? No, what it's telling you is based on historical data, this is the likely movement of the market for the next 90 days. But it's another just estimate, but I can measure what the market's doing today. And tomorrow I can measure it again. And it's real. It's not a guess. Okay? You can do that. You must have a well-defined investment strategy for each type of market. Now, you go to a big-time money manager and you say, what's your strategy? The first thing that money manager should say to you, what market are we talking about? Bull, bear, or neutral? I have 3 strategies. Why? There are 3 conditions of the market. There are only 3. The market's never bullish and bearish. It's never neutral and bullish. It is one of those 3. Always and only one of those 3. So I have a strategy. You can have a strategy. How do you invest in bull markets? You don't sit on cash. That's a strategy. You buy maybe the SPY. It's an ETF. It's a bull market. The SPY's going higher. That's a way to do it. Good way to do it. But you don't hold on to that SPY when it turns neutral. And you don't hold on to it for sure when it goes bearish. Okay. You must have a well-defined set of rules for entry and exit positions. I was talking to a lady just a couple of hours ago. And I was explaining this to her. And I said, here's what I do and how I do it. And she says, oh, but you can get killed in that kind of a strategy because the market could reverse on you. And I said, well, I kind of expect the market to reverse on me. That's kind of what way I've designed it. I know markets do that. But what are you going to do when that happens? Well, my exit strategy gets triggered, and I'm out. She said, what do you mean your exit strategy? I said, I have stops. I have dynamically calculated stops that go up or down, depending on which direction I'm in, with regard to what the particular equity that I'm in, and based on how risky it is, on where it is, on its track or trend. She said, so you use stops as your exit strategy? And I said, yeah. When you come to me and you say, Mike, would you give me a recommendation on a stock? You could ask me, when we get to the Q&A, you could say, would you tell me what you got in the portfolio right now? I will be glad to tell you that. Am I making recommendations on those stocks? I am not. I don't believe in recommendations. I believe in measuring. Is it moving up? Is it good? I want to own it. Does it fit within my diversification strategy? No more than 30% in any one sector, no more than 20% in any one industry. Okay. Important to do this. Over the last few weeks, consumer discretionary stocks have been going through the roof. And I'd get ready to buy, and I've got my program where I'm a little, what's the word I want to use? I'm at a point now where things are so easy for me to just push a button and things happen. So I push a button, and it goes out and it says, here's all the stocks you might want to consider, Mike, if you want to add stocks to your portfolio. And 90% of them would be consumer discretionary. Well, I was full up on consumer discretionary because I'd hit my limit. I have a limit on how much of the portfolio I can have in any one sector or industry. You must be able to objectively rate, rank, and score every stock. Now, that's a little tough. You need a tool for that. Okay? You can subscribe to services. I've got a service you can subscribe to. But you've got services that you can subscribe to that will rate, rank, and score stocks. Right? That's not an impossible thing for you to find. Mine's really good, but there are others. You must know when to go to cash. And you must know which inverse ETFs to buy in a bear bias market. Okay. Knowing what not to do. Never, never hold fundamentally strong stocks in a bear market. Well, that cuts out about 90% of the money managers out there. They want to hold on to good stocks because here's what they've told you. When the market goes down 40% or 50%, we won't lose near as much as the market. And I want to say right back, by the way, this is how I got in this business. I'm an engineer, computer science guy. I built a company. We built enterprise-level software systems for the medical research world. I made my money, and I sold the company and had a bunch of money, put it with a big Wall Street firm. It took them 2.5 years to lose half of it. So, if I never hear a money manager say to me, oh, this mutual fund has beat its Lipper average so many years in a row, I'll be a happy guy. I couldn't care less about whatever a Lipper average is. Because all of my stocks are put in those kinds of things, and that's what happened to them. So the point here is that when a money manager says, our objective is to outperform the market, you might think that's a good objective. That's crap. If the market goes down 50 and your money manager goes down, or you go down 40, you beat the market, didn't you? You think it's a good thing to lose 40%? I don't. Don't do that. That's the best advice you're going to get from me. Don't do that. Whether you put money with me or not, don't do that. Never hold inverse ETFs in a bull market. They've just made you a boatload of money. When the market changes, you get out. Never marry a stock. I guarantee you that if you were honest with me, 80 to 90% of you are married to a stock. You're in love with that stock. You bought it when it was at 50 cents and now it's $50. You wouldn't dare turn loose of it. You love that stock. That stock doesn't love you. It's just a piece of paper. Now, there might be reasons to hold on to it because of dividends and all. I'm not going to get into that. I'm a trader. My average hold time is 108 days. I get a position that's at 108 days with me, and I'm thinking, well, this is getting long in the tooth. Okay? Never be afraid to take a small loss before it becomes a big loss. I know you have trouble with that. I've been in this business too long. I've talked to too many of you. Never have a position without a tactically calculated stop. What that really means is this. And this is another thing you'll never hear another money manager say to you. Every position that I ever put in a client's portfolio, I assume will lose me money and go against me. Therefore, I have a strategy if that occurs as to where I'm going to get out. You cannot predict exactly what the market will do. You always have to assume your trade will move against you. Be ready to get out. So when I put on a trade, I've got my exit strategy right there. I put it in. Okay? Because I could be wrong. That's another thing you don't hear a lot of. I could be wrong on a trade. Okay? You can too. Never, never, never be afraid of cash. Do you know how many money managers are petrified of holding cash? Why? Because they're afraid that you'll get mad that you're paying them a fee and they're just sitting on cash. They won't do it. They're taught not to do it. They won't say this. They would rather you be losing money and be fully invested than sitting on cash. I think that's abhorrent. So I'll hold cash. And you might say, okay, Mike, you're charging me 3% a year. Yeah, 3%, not 1.5%, not 1, not 2, 3%. That's what I charge. And I'm darn well worth it. So you might say to me, you're sitting on cash. We're in a neutral zone. You're sitting on cash. Why should I pay you 3%? I said, well, here's your choices. You could pay another firm 1%, and they could be all in the market. And when this thing goes into a bear market, what are you going to lose? You're going to think my 3% is a bargain. I'm working with that cash. I am working it from the standpoint of not trying to make money with it, but to get it positioned to go into the right equities at the right time. Never listen to talking heads, pundits, analysts, CEO opinions, including me. I'm trying to teach you a way to be solvent in the next bear market. That I'd like for you to listen to. If I gave you a stock pick, you don't want to listen to that. You want to make that decision on what the market is telling you at that time. Okay? Never follow a tip from your broker or a friend. Never. And never let your emotions override your rules. I have a saying. You make the rules make the trades. You never make a trade. Why did you buy that? Pull out your rules. Why did you sell that? Pull out your rules. You don't say, oh, well, I heard Mike Turner say it's in his portfolio and he likes Disney. I'm going to buy Disney. You don't want to do that. All right. So here's what the typical money manager, and I'm afraid many of you who are buy and hold, do. You've got a nice situation going, and I know you can't read this, and I apologize in the back. It's hard to read it up front. So you're doing the right thing. You're up 45%. You do the wrong thing, you're down 50%. This is the market. It takes you 5 to 7 years to get back to even when you're down 50%. Then it moves up again. You're back up looking good just before the next bear market. So what I do is this. All the way across this, there's a bull cycle, a bear cycle, bull cycle, a bear cycle. These light blue lines are neutral zones. The market never goes from bull to bear without going neutral. It never goes from bear to bull without going neutral. Detect the neutral and you'll know what to do. So what I do is this. I do the same thing in a bull market. Right now, I've been running this strategy. Now hold on to your seats. I've been running this strategy all the way since November 1 of 2014. Okay. So you can say, well, good grief. How do I know I can trust anything you're saying? You've got 6 months on this strategy. No, I'm just like Apple. Do you think Apple quit innovating 20 years ago? 10 years ago? 5 years ago? Last year? No. I innovate too. I've had strategies that I have built systems for, poured millions of dollars into, thousands of lines of code, always looking for a way to improve it. Last year, I hit on the the broad market, the bull, bear, neutral, began testing it, and it blew away everything I had ever done. It wasn't a replacement of what I had done in the past. It was an addition to what I had done in the past. And it was significant. So I went to all my clients and I said, I'm going to change strategies. Here's what I'm going to do. Every one of them said, awesome, let's do that. So I'm going to show you a chart in a minute that shows you what my back testing did. Do you want to trust back tests? Don't. Even if I had 10 years worth of history, you don't want to trust that either. Why? Because past performance doesn't equal future return, right? You know that. So here's what I do. When we go to a neutral zone, I go to cash. I pick up this move lower in the market right here, and I go to inverse ETFs. Go back to cash here at a neutral zone. I go into a bull bias trade here, where now I'm picking up the bullish side of this, of the market. I get out again in a neutral zone. I move back into a bullish, inverse ETFs here, where I'm making money going up as the market's going down. That is the concept. Will it always look that way? No. But that is the concept I want you to get. Far better return. Never fair market. We've talked about that. I'm going to move on. So, for those of you who do not know what an inverse ETF is and how it works, it's this. I'm going to show you the market from 2006 through the first few months of 2009. That's where serious pain occurred in recent past. And here's what the market did. Here's the S&P 500. Moved up nicely in 2006. Everybody's a genius. Moved up again in the middle part of 2007. Now you're a raving genius. You're bragging to your golfing buddies and whatnot. You had a dip here, but it came right back up, and you said, see, I was right. And then all hell breaks loose. And we start moving down. Rebounds to kind of give you false hope. Goes back down again. A little bit of a bounce. You're thinking, okay, that was the bottom. We're done. And then the bottom falls out. Now, that is the market, S&P 500, as represented by the SPY. It's the same thing. Looks exactly the same as the S&P 500. Now, there is an ETF that moves almost, not quite, in the opposite direction. It's called the SH. Market's going up here, it's going down. Market goes down, it goes up. Exactly, almost exactly, an opposite move to the market. So what I do is this. I look for those. We go to neutral right here. We pick up inverse ETFs right here. I buy here in this area. I won't buy it right at the bottom, but I'll buy in this area. And I'll sell it when it gets back to neutral. The market, in the meantime, is going down. I'm going up. The market's going down. That's what an inverse ETF does. It goes up when the market goes down. It has everything to do with your timing of getting in. Okay? So here's another one. The market started going back up. I got out of the inverse ETF, got into the market. It topped right here at another neutral point, rolled over and went down. You get back into inverse ETFs and you make money here while the market goes down. So every time that happens, you're stair-stepping, you're juicing your portfolio higher while your friends are suffering, while the mutual funds are getting decimated. Okay? And then the big kahuna. We come out of this neutral zone right here. You buy inverse ETFs probably in this area right about here, not here, probably right about here. Because you've got to prove that it's actually a breakout. And you hold on to it to here while the market goes to oblivion. That's what you do in a bear market, not in a bull market. Okay? Okay, so here's summary. When you have a bull market, this is the strategy. So if you came to me and said, Mike, what's your strategy? What's your investment strategy? I say, well, we've got to take it into three parts because I've got a bull strategy, a neutral strategy, and a bear strategy. Which one do you want to hear first? So in a bull strategy, you're above the neutral zone. You remain fully invested, only fundamentally strong, uptrending stocks. By the way, I don't care which ones, so long as they stay within my diversification rule. No more than 30% in any one sector, no more than 20% in any one industry. Monitor the trade risk and intelligent stop loss setting. Okay, well, how do you do that? Well, you can subscribe to one of my to my other service, and you could have access to those tools. You could also let me manage some of your money, and you get those tools for free. So it's kind of an incentive. But basically, we monitor how much risk is building up in a trade based on whether it's trading in its normal trading zone, in a what we call a hold zone, or overbought or oversold condition. And then we set stops that are based on expected moves and last week's lowest low and things like that. But it doesn't matter. You don't have to use my exact formula, but you need to have an exit strategy for every position you've got in there. Don't hold on to a stock because it's been good to you. Dump it before it dumps you. Okay? There's a commercial I love. It's so arrogant. There's got this guy, he's a comedian, and he's standing there in front of some cars. And he raises one eyebrow. He's looking at the cars. He says, okay, I admit it, I have a wandering eye. And he's kind of like treating these cars as if they're objects of affection. And so he goes through the whole process about how he picks one over the other. Okay? And you know that he's a very shallow individual and all this kind of stuff. That's what you want to be with stocks. You want to be very shallow. Okay? You want to have a wandering eye. You don't pick a stock and say, oh, Mike said it was great, Louis said it was great, Fisher said it was great, whoever said it was great. Okay? Don't do that. You want to do it as long as it is making you money. In a neutral strategy, you want to stop adding new positions. Stop. You hit neutral, stop. Don't buy any more. Okay? You want to capture profits. What does that mean? That means you want to sell, you want to look for opportunities to take money off the table. You got any stocks that have been kind of flatlining, get out of them, put tight trailing stops on. You want your objective by the time you get out of the neutral zone is to be 100% cash. Now you should be thinking in your mind, well, Mike, I say it was a bull cycle. You went to neutral because of your thing that you follow. And you come out of that neutral zone and it goes right back into a bull market. You were wrong. No, I wasn't. I just buy fundamentally strong stocks that are trending higher when we come out of it. Yeah, we sat on cash for a little while. But look at how I protected your position of what might have happened. I'm not afraid of it going into neutral. A few weeks go by and it goes back into bull mode. It doesn't mean I was wrong. It means that that's what the market did. And we're going to make money that way too. Use tight trailing stops, your objective. Be 100% cash by the end of the neutral market cycle. And lastly, if you're below the neutral zone, you want to remain fully 100% invested in inverse ETFs. Now, when I say 100% invested, you don't take your life's savings, everything you got, everything that you're living on, and you put it all into inverse ETFs. I'm talking about the money that you have set aside to invest, not the money that you're living on or that you have to maintain a lifestyle out of. That money needs to be protected all the time. I'm not talking about that, okay? Only broad market, highly liquid inverse ETFs, both focus on both sectors and big indexes. And monitor that same trade risk and intelligent stop loss. So, here's how I do it. Here's my heat map. I know you can't see this. Trust me on this. This is a long-term, 10-year, in this case, 10-year moving average. It's not a 10-year moving average. It's a 10-year chart of a long-term moving average of the S&P 500. I have developed a formula that tells me what that, I know you can't see it, but it's a shaded area right along that dark blue line. I know by looking back in time that the market stayed above this in bull mode It bounced around in this neutral area in a neutral zone, went into a bear cycle in this bear cycle. And I know that this average and this zone has been phenomenally accurate in telling me what condition the market was in. There's an old song in the 60s. What condition is your condition in, I think? Something like that. Remember that? So, sorry, giving my age away here. All right. So right now we're in a bull bias. What's important here, looking at where it is, looking at how much it is above the neutral zone. And when I did a screen capture on this, it was up 0.86%, it's now up 1.82%. But I look at all of the major indexes, I look at the sectors, I look at the time cycle forecasts. All of these come into play, helping me make a decision of whether or not I want to be bullish, bearish, or neutral, and how aggressive in each one of those. The thing that says whether or not I'm in a bull cycle, or a bear cycle, or a neutral cycle, though, is that spot right up there. Okay? So here are the results. The following are the results of a 10-year study that includes an exhaustive blind backtest of thousands, many thousands, tens of thousands of simulated trades. So read this and I'll show it to you. Come on, read. Hurry. We don't have a lot of time here. Okay. Okay, let's get to the bottom. Actual results will vary. Thank you very much. You've read this before, haven't you? Okay. Now, you see this blue bar? Maybe the only thing you can see in the back. This is live trading since November 1, 2014. Oh, a long 6 months ago. Okay? I'm pretty proud of that, actually. I've doubled the market. I'm up twice as much as the market is. Market's up 4%, I'm up over 8%. Not bad. My goal is to at least match the market in a bull cycle. In a bear cycle, I want to knock the soup out of it because the market's going down and I'm going up in my inverse ETFs. So, in the back test, by the way, this back test, I'm not going to run the actual portfolio exactly like the back test. The back test, I put one ETF in. It was the SH. In the real world, when we get to a bear market, I'll be putting us in about 5 different inverse ETFs for all the major indexes. Maybe a sector or two, maybe. So I'll be more diversified than what this back test shows. But the bear market, we went up, the market went down. And when I say blind, let me explain to you what blind means. We built the program and we said, it is January 1, 2005. Nothing else has happened. Go out and analyze the stocks up to that date. You can only look at the data up to that date program. Pick the best ones, show us what they are, and we'll buy them. As I went through the process, it was making recommendations to me blindly about what to get into and what not to get into. Okay? Here's what's interesting. The 2008 crash took nearly 5 years to get back to even. You're back to even here, and look where I am. And again, simulated, but look where this is. Look at the difference. Here we're at up 30 some odd percent, or right at 30, and here we're in that same time frame we're up 180%. Now, I'm not going to pretend to you that that was real. You should not trust back tests. In fact, you shouldn't trust, even if this was real trades, you shouldn't trust it, because the history of the market does not dictate what the future of the market will be. I'm trying to show you a proof of concept that I use in managing my money and my clients' money. So, at the end of 10 years, plus 6 months or thereabouts, We're up 281%, market's up 78. 365% better return. Am I promising you a 365% better return? I am not. I am promising you that everything I took you through is what I do every day. This process I use. So, here are the stats for the last 6 months. November, up 2.5. I'm not going to read all these to you. But this is how I've done every month. Ignore April. And then we've got May. This is my only losing month. Down 2.6%. Had somebody earlier ask me, why did that happen? Well, that's just the stock market. I didn't change my strategy. The market went down after we had moved up nicely. It still stayed above the neutral zone. Okay? Not a big deal. And we're nicely, this is not the end of May, of course, it's as of, I think, Friday. Total return so far, since I started the strategy, 8.6%, market's up 4.3. Okay? Roughly a 200% gain. So, respectfully, and then I'm going to take questions. I'd like to build a tactical portfolio for you. This is what I do. It's a managed account process. Your money, your account, but I'm picking the stocks. Right equities for the right market trend is what I try to do. Quantify risk of trade. I set multi-tiered exit strategies. Our investment strategies are under constant review. Thank you. And they could change. We've got a lower adjusted profile, risk profile. We want to generate significant returns in both bull and bear markets. Bottom line, better performance, less risk. We've got some brochures that go into more detail, but I'd prefer to only hand those out to people who might consider us doing money management for them. And that's it. So I will open up for questions.
What are the other ETFs you're talking about besides the SH?
The question is what are some of the other inverse ETFs? If I can get back here quickly enough, I'll show you in the heat map. There we go. The major ones that I look at are the SH, which is this one here, MYY for the S&P 400, the PSQ for the NASDAQ, the DOG for the Dow, and the RWM for the Russell 2000. Another question? Yes, sir.
Some of your spikes on your back testing are almost 40%. What do you do now to
Yeah, the question is, when you look at the back test, you'll see that some of those were radically high. What happened there, which the model was not set up to handle, was that there was a one-time, only time, never again time, according to the ETF owner, sponsor. They declared a 13% dividend. It just shot that ETF to all hell. So what? And again, we're measuring on a day-over-day basis. So it may be up a lot in one day and down another in that particular instance. That's what made that happen. The fact that I'm going to be diversified in 5 or 6 different ETFs will ameliorate that significantly. I don't expect that to happen. But full disclosure here, I have not taken this methodology through a bear market in real trading yet. I expect to have that opportunity pretty quickly. Yeah, in the back. Yes, sir.
compare and contrast shorting stocks versus the inverse?
Okay, the question is, what about shorting stocks instead of using the inverse? I don't short because so much of my clients' monies are in tax-deferred status, and there's no shorting. So I don't short. I'm not altogether sure that even if I had that opportunity, I would. I like the fact that the inverse ETFs are not so radical that the shorting that you get in shorting. So the volatility is a little bit less. Yes, sir.
What do you think of people who say that you're trying to time the market and timing does not work?
Okay. Yes, and that's a stupid remark. Not you, but whoever says that. I've heard that timing doesn't work. You know, I was reading this morning. Alan Greenspan pontificated yesterday, I think it was, And he has, and I'm not trying to say that I'm smarter than Alan Greenspan, but at the end of the article, he said, everybody just does buy and hold anyway. That's the only way. No. And then he said, you cannot make more money trying to time the market than you can just buying an index. You can't do it. It wasn't that you might not be able to, it's that you can't do it. So saith Alan Greenspan. Dear Dr. Greenspan, you're full of it. Okay? Yes, you can. Now, I don't have a problem with you saying, I want to only buy ETFs, indexes, in bull markets and ETFs in bear markets. I don't have a problem with that. And that way you're not having to pick individual stocks. But let me tell you about ETFs. You get a basket of stocks. Pretend that you are Warren Buffett and you decide to buy a town. So you go into a town and you look around at all the stores along in the town. And initially you're thinking, I'm just going to buy some stores. Say, no, let's buy the whole town. I got a lot of money. And so when you buy the whole town, what kind of stores do you get? All of them. Are all of them great stores? No. Some of them are crap. So that's one of the problems that you get with an ETF. You get some crap in there. And there is no argument that, that timing the market is more difficult. I don't know, and as arrogant as this may sound, and I don't mean it to be arrogant at all, maybe I'm better at it than what these other guys have been over the years. Maybe my approach just happens to work. Yeah?
What about the tax ramifications? This sounds like it might work if you had an IRA, but if you were just had a regular account, sounds like most of your stuff is short term.
Everything is short term. You're not going to get long-term capital gains, and I hope to make you pay a lot of taxes. I don't like paying taxes, and I'm not saying that flippantly, but I want to make you a lot of profit. You're going to have to deal with that. This, again, is not a tax mitigation strategy. You're hiring me for one job and one job only. Make you a profit. That's all you're hiring me for. I don't get involved in end-of-life financial advice. I don't get involved in any other aspect of money management. My job is to make you money. Yes, sir?
About the 2-to-1 inverse ETF.
Okay, the question is, what about the ultras, the 2x, 3x ultras? Don't like them, stay away from them. Okay, why? They're too volatile. And generally speaking, they're too thinly traded. Buying is so easy. Selling is hard. And selling when you want to gets impossibly hard if you've got a thinly traded ETF. I'm going to take about 2 more minutes and then we got to go. Yes? Okay, the question is, when I set stop limits, which I do, I don't use stops, I use stop limits. How low would I set those? It depends on the stock. Generally speaking, I go off of what the stock's expected move is. In other words, here's my objective. Every stock has volatility. Okay? So if you can watch me here, I'm going to move up. This stock is climbing up, it's going like that. What every trader wants to know is the difference between a dip down in volatility as opposed to a dip down in a change in direction. If it's a change in direction, you want out. If it's just volatility, you want to stay in. So I measure what the volatility is, and I set my stop just below that. Some stocks have a 1-2% volatility. Some have 13 or 14. I tend to stay more in the 10 to 12 range on the percentage. One more question. Anyone?
I did.
Yes, ma'am.
Minimum buy-in.
The minimum buy-in, oh, thank you. I thought you'd never get that question out. The minimum buy-in is $50,000. Okay? And if you want to trade some of your own money and you want the tools that I use, I have a subscription company where you can subscribe to those, but as a client of mine, your subscription is free. Thank you very much. And we're in booth number 525 in the back of the exhibit hall. Thank you.